Hi traders, welcome to TCM Education, and the topic of this video is one that we must acknowledge that it's super important: risk management. Okay, so what is risk management for investors? We all know there's a lot of risk. Anywhere you look, a stock can move up or down overnight, anywhere between 5–10%, and sometimes things can go really wrong, like 25%. We've seen ugly numbers. Mostly the big numbers won't happen on S&P 500 stocks or leading stocks, but no one can guarantee that it won't happen. So what can you do as an investor to protect yourself? If a gap occurs overnight, nothing. If you are leveraged, even worse. And sometimes brokers in the US will allow you a 2-to-1 leverage overnight, and if you're you can end up with a huge loss, because what happens if the stock gaps up and continues moving higher? A gap up of 50% can throw you off balance, being that you're going to lose your account. And that hardly ever happens, but that's something that is on the table. So when we are talking about day trading, we know that we're not exposed to gap ups. Therefore, whatever happens on a gap, if it is a positive gap or a negative gap, we have closed our positions by 358. And that definitely is not an issue. So for day traders, gap ups or gap downs are not an issue, unless they happen during the trading day, and that can happen if you are really in the wrong place at the wrong time, which means you're trading the high flyers, low liquidity stocks that may get halted because of. Now, sometimes the stock can be halted because of intraday news. It hardly ever happens in the leading stock. So when you stray away from the leading stocks to stocks like BMNR, your risk management must be like a hawk. And I mean, let's share this example right now. This is the morning of July 9th, the stock gaps up. So the stock closed yesterday at 110 and gaps up to in the first minutes to at 1.126. This is the 3-minute chart. So in the first 10 minutes, in the first 3 minutes, the stock moves up $10 from the lows 117 to 126, $9. Then holds for a bit and then drops under the lows or breaks the lows, and it's gone. Now, what are the scenarios for those who bought this first bar up? You can see in the first bar there were 300,000 shares bought. You can be 100% sure that somebody got here off guard without a stop loss in the platform, without the right preparation. I hope it didn't happen to anybody, but I'm sure it happened, or most likely happened. So what can you do? So if you don't have a plan when you enter the trade, tough luck. Now if you trade this stock and you don't know what you're doing, it's even worse, because this is a stock that can move 30, 40. We've seen it move 100% per day up. You know that anything that can move 100% per day up can do the same, meaning 50% down. And today it's actually doing it, 45% down at this point. So again, risk management in this case, it can be harmful even if you are a day trader, and you can lose a lot, get into a situation where you're thinking, wishful thinking, that it will reverse, and it's not reversing. And that can be the end of your day trading career, a move like this. So let's agree that we need super tight risk management. We need super tight plans for risk. We need to trade the right stocks, obviously. We need to stay away from spready stocks. All of that is clear to all of us, yet there are those pitfalls when the greed takes over, and then you either overbuy too much, or you ignore the stop loss, or you don't place your stop loss in the platform. And if you guys followed many of our videos, we discuss the issue of posting a stop loss in the platform. When we use this the smart trading strategy, which is 1% of risk with a stop loss in the platform, no matter what. Now sometimes you don't have the time, it moves so fast. I mean, in this stock 1% is $1. $1 moves here in maybe in microseconds. It can move $1. Sometimes the spread can be $1. So let's ignore this stock. Let's move to something more normal. You know what? Let's go to the best trading stock in the market, NVDA. Why NVDA is the best trading stock in the market? Because it trades 120 million shares and the volume is very low today. It has absolute perfect liquidity. You can buy and sell almost any amount of shares per 1 cent as a day trader, not as an investor, but as a day trader. You can press the button, buy 2,000 shares at the same price, or with a limit price at 162.65, and you may get the whole 2,000 shares in one whiff. And if not, it's going to be a cent above or below. So extreme liquidity. Okay, still, when you trade even the most liquid stock, and you know that 1% in NVIDIA is $1.60 right now, and you want to take a trade, you need to take into account the worst scenario. And the reason for that is that if you don't take into account the worst scenario, and you start lifting your guards, the losers are going to come piling in, and then all your work of the previous day, maybe days, sometimes weeks, will go down the drain. And here you need to understand that when you're trading, it's not like a regular job. When you're not coming to work, or you're doing your job in a lousy manner, they don't deduct your pay. Maybe they will fire you, but you're not going to lose money on that working day. It's not the same here. Here, if you're doing a terrible job, you're getting punished by losing money. So risk is super important, and there are ways where you can make things worse. So you buy too much, you don't have a strategy, and when you buy too much and you don't have a strategy, and you don't respect the stop losses, or you don't respect your targets, so there are those factors pretty much are going to hurt you. Anytime you don't have the whole package lined up, it's going to hurt you. Now you can have the whole package lined up, and you're going to take a loss of the trade, and if the loss of the trade is going to be 0.5% or 1%, that's a given. Nobody's going to run in fear of losing 0.5% on a trade. And it doesn't matter how big the trade is, because you decide how big the trade is. If it is part of your plan, and your plan is to buy $100,000 of NVIDIA, which is like 600 or 700 shares, and you want to risk 0.5%, that's $500, and you have your stop loss in the platform, most likely that you're not going to lose more than $510 or $20. So meaningless, okay? But it's not the case with many other stocks, where sometimes they are spready, sometimes there's poor liquidity, sometimes you don't have enough time to place the stop loss, or you're not even putting the stop loss in the platform, and the trade runs against you, and then you are caught off guard, and you were watching a 30-cent or 50-cent loser turn into a big loser. And it can happen, and it will happen, and it happened to everybody here, I'm sure. So we all know, we all been through this type of losses. Not that's on the downside. Now there's the upside where you sell before your target because you're not very experienced, or you don't have the mental awareness, and if you don't have the discipline to manage on the downside, how can you manage on the upside? So the discipline most likely goes both ways. So if you're winning on a trade 10 cents or 20 cents and you're losing 30 cents or 40 cents, you have no chance. You have to let the winners ride. Assuming you are a terrible trader, as long as you let your winners ride, then you have a chance. But you don't have a chance if your average winner is less than an average loser, and you are a terrible or not terrible, listen, the wrong word, an inexperienced trader. So when we are talking about our strategy, which is, if you remember it, no more than 1% of risk, 3 to 5% as all the highs of the day as the target, trading only stocks above 5 million shares. There is a reason for that. 5 million is not a random number, okay? In this case, this stock here, where is it? Hold on a second. Let's go back. BMNR. BMNR trades. Let's see how many millions. 17 million. So that's a lot of shares, but on top of that, there is something that we call liquidity per cent, and or spread, and you cannot be serious not to watch the spread in this stock, and the spread in this stock varies from 20 cents, 50 cents, which is a lot. 50 cents is on a $60 stock, that's 1%. You pay only for the spread. And how much do you pay for the spread in NVIDIA? 1 or 2 cents, which is 0.001%. So that's instead of paying 1%, you pay 100 times more for the spread in BMNR. Okay? And now I'm not talking about the reward. I'm talking about the risk and the cost of doing business. Indeed, the reward here in BMNR can be outstanding, but the cost of doing business, which is the spread, assuming there are no commissions, and on top of that, the extreme volatility of this stock, which sometimes can go against you very fast, and you won't be able to post a stop loss, or it won't be accepted because it goes too fast, and you need to sell with the market order, and you're panicking. So okay, so push comes to shove, we need to take care of the risk, and this is all part of the plan. Now many traders are looking at stocks, and they say, okay, I'll have a stop loss. I know what, not many traders. Let's see an example. Let's go with Alibaba today. Hold on a second. Big names. Alibaba is down whatever percent. And this is the chart of Alibaba. Let me add the VWAP. In a split second I will add it. Why it's okay. Okay. VWAP. Well, for whatever reason I cannot add it. Okay. Hold on a second, guys. Okay, sorry, here it is, the VWAP. So let's talk about Alibaba. The stock gaps down, continues lower, but at one point it reverses over the VWAP, okay, as you can see here, and breaks 104.50, goes to 104.80, and then comes back down and trades. And let's say you make a mistake here, and you think you can buy this stock over this reversal at 104.80, and you make a huge mistake. The stock moves up 6 cents and starts diving. Okay, so Alibaba is very volatile. It trades millions of shares, and you don't have a stop loss in the platform. You want to use the VWAP as your stop loss, but you're thinking, okay, maybe the stock changed its downtrend, which happens very often in a stock like NVDA. And you can see here the higher lows and higher highs channel, and you wonder why won't this phenomenon, which is easily observed because it takes place over more than half an hour, continue. And then you're thinking, okay, it's going to come down to the VWAP and reverse higher, and I will be fine. And it's not happening. And the stock continues to move lower, and then it reverses again, and then the same scenario, and you hope again, and it doesn't, and by now you have a big loser. If you had any hopes, they're vanished. Okay? So again, it can happen on a crazy mover like BMNR. It can happen in Alibaba. And now, let's say you're caught in this loser, which is now by now from 104.80 to $1. So that's a 1% loser by now, and on zero ability to be in the money. I mean, you were in the money 4 cents, and now you are out of the money for $1. That's embarrassing even to think about it for a day trader. Okay, and all of that because it didn't respect the plan. And your plan was basically to risk down to the VWAP, which is 40 cents, less than 0.5% on this trade. Big mistake, but it can happen. Okay, we've been trading Alibaba plenty of times. It's very neurotic and can change directions many times. One of the reasons I am staying away from it is that it's really a tough trade, and that the ranges are not very good. So not trading Alibaba, and again, it doesn't fit our strategy anyway of 1% risk, and ranges are super important to us. But again, let's go back to this scenario. So now your excuse is, okay, it's down 1%. I will wait overnight, and you don't know what's going to happen tomorrow. So you may turn a 40-cent loser into a $1 loser, and maybe into a total loser, $2, maybe more, who knows. Okay, and all of that, you cannot do anything here. You have money tied up in Alibaba. You're now worried about managing this stock. You're not looking at additional trades. Most likely you're hoping that by some miracle this stock is going to turn around. So your whole focus of day trading, this whole day is destroyed. Okay, most likely you're not going to make money, and maybe even lose big. All of that because you didn't pay attention, you didn't have a plan, or even worse, you didn't adhere to your plan. And one of the reasons why I say put the stop loss in the platform, and many people are telling me, no, market makers know where my stop loss is, I'm stopping out, and then the stock moves higher, which is total BS. You're stopping out because your trade was lousy, the timing was terrible. Nobody cares in the market about your 500 shares or 1,000 shares, and this stock trades 15 million shares. Nobody cares. Okay, nobody cares, or nobody's watching. Okay, there's no big daddy that's overwatching our trades. So in this case, it's all on us. You need to take responsibility and do the basics. And the basic, which I hope you will adhere to them, are always, as a day trader, Again, it's your account, you can do whatever you want. Trade with a stop loss in the platform and have a plan. And the plan should be one where you lose very, very small. That's cardinal. You lose very, very small and hope that your trade is going to make a lot. What is a lot for a day trader? 3% intraday, 4%, and if you're lucky, maybe 7, or we've seen trades of 10% intraday. But let's not, 2 trades per day of 4% are 8%. And 8% on $20,000, it's $1,600. So you can have 16 losses of 1%, 8 losses of 1% to cover those two wins. And this is not going to happen if you are an average day trader. An average day trader will go 1-1. Even if you go 2-1, you're going to be still a nice winner. 2 losses, 1 winner. You can still manage to be very, very positive. Again, if you adhere to these strict rules with regard to risk management. So when we say use a fixed account or fixed position per trade, it's not a whim. Why would we invent that? It's because you're creating a system that can work without changing your strategy or your way of thinking every trade. So Alibaba, I'm buying 300 shares, if it is Walmart 400 shares, if it is NVDA 600 shares, and then the stop losses. Here, if you have a clear state of mind, you can really focus on what's best, meaning the stock first, okay? Trade from a very, very small pool of stocks. That was the concept of the strategy, and then look for the 1% entry, and then trade $5,000, $10,000, $25,000, $50,000. It doesn't matter. And trade, of course, very liquid stock. And we said on our power list that we don't trade anything under 5 million shares, which means the liquidity must be perfect. We know it's not, but at least the demand is 5 million shares when you enter the trade, so you don't have a problem entering the trade, and sometimes you'll have a problem exiting, but most likely you won't. Again, we are day traders. We're not piling in with thousands of shares per trade. And if you take a $20,000 position on a $200 stock, guess what? How many NVIDIA shares are $20,000? 130? What's 130 shares of NVIDIA is... hold on a second, guys. I don't want to make a mistake here. Just to make sure. 20,000 divided by 160. Yeah, 125 shares. I mean, 125 shares of NVIDIA is laughable. Laughable. Okay, so we're not trading NVIDIA because that most of the time doesn't fit the strategy, but CRCL does fit the strategy day in and day out, or CRWV. And those stocks are in that ballpark, like 170, 180. So we trade small positions, or relatively very, very small positions, and counting on the outcome versus the risk. So if the risk is 1% on a $20,000 position, which is $200, and you take 3 or 4%, that's a job well done. And that takes care of the risk, of the management, of not buying too much, or making a last minute or last second decision how much to buy. If you have in your brain, tattooed in your brain, all my positions are $20,000, all my positions are 1% risk, I'm looking therefore for those setups where I can get on a trade 3 to 5%. And if I can get 6 or 7 or more, so be it. But I have a clear state of mind to look for those specific trades. And if we're looking for other trades, like for example this Alibaba, which is a legit trade, and so you lose whatever happened here, 40 cents. Okay, so and they took a $500 position, which is in this case how much is it? $50,000, I think. 100 times 50, yeah, $50,000, and you lose $200. That's 0.5%. Okay, it's not 1%. Again, the risk reward here won't let you trade a 1% risk on this. Let's call it scalp play. Okay, guys, I think we summarized this subject. You need to be very, very consistent. You need to have a plan. You need not to be taking big positions. You don't need to if you're looking for the right stocks. And you need to respect your stop losses. And you need to respect your take profits or use a strategy, which is let it run, sell at 358. I hope it was illuminated and clear enough. If not, you can write your comments. We'll have, in addition to this video, we have another one that we posted early on today about discipline and emotional control, and we'll have a couple of more videos on this subject, which is poor decisions, poor risk management, and overall areas where we as day traders fail again and again, and those need to be fixed in order for things to work smooth. And there is a way. There is a way to deal with all those small pitfalls. Okay, guys, again, thanks a lot for being here. Do like, subscribe, it's important to us, and we'll see you in the next video.